day all. Ira Epstein of Linn Associates with your agriculture update, and we are now on Monday, the 29th of July, 2019, just after 4:30 p.m. Central Daylight Time. So here we are in a week where there's a lot going on. This is going to be a big financial week. We've got a whole slew of financial reports tomorrow. Today we got the USDA crop progress report, and I would view it as a little bit bearish to markets. There was a slight improvement in most of the grain areas. I'd be surprised if we're not down a penny or so. There is a gap in the D's corn that the market may eventually be targeting. It's in the 420 range. It missed filling it just about a week or two ago when it got to 420 and a half, but it did not fill it. So it's still there. It might go for it. And as we look at all the other grains, you do realize that when you wake up in the morning, you'll hear the first talk, or maybe you won't, about the U.S.-Chinese trade talks where in Shanghai they're resuming. But the time they're resuming probably is going to be an hour or two from now, so we'll see what goes on. Remember the time differences. Dollar index was up on the close, but the reality is it was a bit lower on the day. It's like looking at gold right now. It's really closer to 1440 at the very last trades of the day than 1433. So as we take a look at the soybean market, I see the battleground on the weekly chart at the 18-week moving average of closes. That's the red line. The other parts are just a closing basis, and that's why that's called a weekly area chart of closes. So as long as the market stays over that number, I view that red line as the support number, and that's around the 871.5 zone, and the market finished today at 885 3/4. No magic there. We'll see what happens. I think the market's consolidating here. We get on August 12th a new number from the USDA in corn, and that number is going to be an acreage number that probably sees a substantial shift from the last numbers the markets have been working on, because nobody believed the USDA report was accurate with all the flooding and the acreage that didn't get planted. So we'll get some new numbers, and from there the game really begins. In looking at no beans, I think you'd agree we're sideways, and what I'm seeing is volatility gradually shrinking in right here. Will the market be able to take out these lows and penetrate this area, the 890 level, is probably on a lot of traders' mind, but on the swing lines, you're in a downtrend. You have a pretty clear pattern here of lower highs, lower lows at this point. The market is fighting a battle between the green line, which is the 100-day moving average of closes, and the red, which is the 18. So as the market's gotten under that 18-day average, I call the bias down, and on the rallies, it's been encountering resistance between those two moving averages. As we take a look at Bollinger Bands, which are these black dashed lines, remember what they are. They're an algorithm designed to keep the market trading within them 95% of the time. And yes, as you see right behind me, this market can get under them, but it will, if you go back in time, stay about 95% of the time within the bands. Well, what I'm seeing right now is a pattern that became sideways, and it did it at the beginning of July as the market headed from this really big rally high at 950, and it's pulled back here trying to figure out what's the next move. In terms of momentum as measured by the slow stochastic indicator, it is down and it is in oversold territory. I define any number as oversold as when these numbers, either one of them, are under 30. Now, when they both get under 20 or both get over 80, they change and they lock in a trend that I define as embedded in slow stochastics. You do not have that right now. So, in summation, we're in a resistance area. The market's in a downtrend with downside bias in an oversold condition. In the meal market, set meal, you have hit a downside target. And generally, the word's generally, not always, when you first hit a Bollinger Band, be it on the downside or the upside, I look for the market to view that as a support zone. And that's what happened. We've gotten a bounce. Is it a change of trend? No. In fact, there is no trend. You have had a pattern of a higher high and a lower low. The bias have stayed down, and you're still in an oversold area. In soybean oil, this is that other part of the dog. So you get the meal and the beans doing one thing, and that tail sort of moves around as the traders are trying to figure out what to do in what's called a cross spread. And it's been kicking this market to higher lows, higher highs, but you're in a pretty serious resistance area as measured by the upper Bollinger Band and you've gotten and been fighting to stay over the 100-day average of closes. Should this market take out 28.37, this uptrend would end. That does not mean it's a downtrend, but it would come to an end and you are overbought. So I'm not convinced traders are just stepping in there, get a bullish piece of information in the whole soy complex, maybe. In the corn market, as I said, the market is now in the D's corn trying to figure out what to do with this whole area. You'd have to have me take off this chart area right through here and the other studies to see the small gap that's left in. I forgot if I had it there or it's back here, but it's in the 420 area. And as I'm looking at the market, you're still very much in a downtrend with lower highs, lower lows. You are oversold. Support comes in right at that gap on the Bollinger Bands at 419 3/4. You could see more slippage, but I think the trick will be trying to stay under that 413.5 area unless the acreage number on August 12th really comes out with more acreage than we all think is out there. In the wheat market, you've had an outside day up today. So that puts the swing line, as I define it, with higher lows. Now, the question is the high. The old high was 507.5. You didn't quite take that out. So I'm looking to see what this market does. If it can take out that 507.5 until the market takes out today's low, I think this market is liable to see good buying on the breaks at this point. A potential target could be up at the upper Bollinger Band at 524.25. Momentum turned up. You had lost the embedded reading when I was out of town. This is embedded. The market, when it loses, it often goes to the 18-day average, which is exactly what it did in this case, and it's fought a battle for the past 4 days right at that. In the sugar market, the pattern is now one of higher lows. You've had the higher high. The settlement today was under a key number, the 1209 area, which is the 18-day moving average of closes. So you either get under 1193, and if you did that, you could end up with lower highs, lower lows, back into a downtrend, calling for the 1147 area. Or if the market moves up and gets over 1223, you put into play the potential for the 1260, 1270 level. The 100-day average in the upper Bollinger Band. Momentum is still pointing up. So you've got two of the three elements of an uptrend, but they're not all in line. In the coffee market, part of what happens in coffee is via Brazil, which is a major grower and exporter of coffee. They're having serious financial issues. And in early August, the Brazilian president today announced that he's going to come up with a new budget. Well, if that gives the real a bit of a bounce, you might see that in the coffee. But right here, all that's happened is you're in a downtrend that went to the combination of the 100-day average, the lower Bollinger Band, and it's trying to grab hold. The problem is you've now got the embedded reading. Embedded means you've converted the market over from being oversold into locking in a further downtrend. If that's the case, you'll know that by tomorrow the market's just hugging this lower Bollinger Band or being under it, and it's telling you the market might want to accelerate to the downside. I'm wrong in my thoughts. If you take out 102.65 tomorrow, that might be enough to kick the market to higher levels. In the cocoa market, this has been a son of a gun market for traders. It's gone from a low point to a high point, back down to a new low. These are not small moves. This move to this move's almost 200 points and then right back down. The broader trend down, oversold into a support zone. In the cotton market, I don't think today's report was anything bullish for this market. We'll see if I'm right or wrong. The market's had a pattern of higher lows, higher highs, and it's fighting a battle at what I call the line in the sand, the 18-day average of closes. That's often a number that you get back to when a market fights at it looking for direction. Momentum, well, it's still pointing up, but you're in overbought territory. You're fighting at that battle point. We'll see what it does next. In the cattle market, a pretty big reversal day with lower high, as you can see. You took out Friday's high and low, closed lower, probably making a run at that 18-day average. You are correcting an overbought condition in the marketplace. It's what I call a chart that's looking for its direction here. Feeder cattle. Lower low, higher high. That's not a trend. Notice how momentum's trying to flip over on you now. Now, if we look to see if it was embedded today, both numbers, let me show it to you. Both numbers over 80 today. Both numbers were over 80 on Friday. Not so on Thursday. You're just in an overbought area that might find its way back to that 18-day average to see what it's made out of. The problem is if it gets there, it's probably still going to be in an overbought zone. And today in the hog market, the uptrend that you have had in place since this low ended today. Now, why do I say that? Because I would have argued that you had higher lows and higher highs. I'd also argued that when you got to the 100-day average, finally, when I was out of town in the upper Bollinger Band, pretty stiff resistance. Take out this low of 77.95 and you break the pattern of higher lows, higher highs, which happened today. Now I'm looking to see if the market gets back, and that's what I'm expecting, to the 18-day average to regroup. It's hard to get overly bearish when you know the trade talks are going on as we're talking in Singapore now, and once that, in Shanghai, got that one wrong, in Shanghai. And as that takes place, you really have the guts to take positions one way or the other in agriculture, because what the market's looking for is to see, can we make any trade deals? There was a good amount of soybeans bought, about 600,000 metric tons that was announced today, and that's, I think, the largest purchase since last February, but that could just be you put some money on the table as you play poker and you negotiate. You know, our good friends at Modern Trader, and I see that they've got their website up again. I haven't been able to talk to the people, but they're the ones that put this out. If you go to their website, it's pretty interesting. All their old magazines are there. You might want to get them. But the contents of this particular publication that I certainly had permission for them to redo with them gives you an idea of all these different parts in the market that you might find really interesting to help you with your trade ideas. This is how the articles look. I find them fascinating. I've been a fan of this magazine from the first publication it ever came out with. They're not in business, but that happens. You know, things go digital, then they seem to come back at you in a different way, and I'm hoping that that's exactly what happens here. But if you'd like a copy of this, we've made it into PDF. Give us a call. You can go to our website, free offers. We'll take it from there. I'm Ira Epstein. Good to be back, and I'll see you tomorrow.